Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so Neil, you were referring to the YUK. So let me repeat Neil's question here. So Neil was asking, is there a particular reason that you thought the last example would go lower? It had made a higher high before and possibly been rejected by the 62% retracement. I think what Neil is referring to is the fact that, well, you know what, Neil, I'm still not quite sure what you mean, because let me just make sure that that you're understanding what my analysis was. So I was looking at basically the high to the low here that occurred, the low on the 4th. So we hit the 61.8, and then so I would identify that as potential resistance, and then be looking for the downside. But you know, the fact of the matter is, it's quite likely that, short-term trading is, you have an inherent loss ratio. So there are certainly times that you're going to be wrong. And oftentimes, looking at the same opportunity, you may trade it once or twice before you get the winner that you were looking for, especially when you're trading on the short term. Okay, so Susan asks, so what levels carry more weight? Is the 38.2% stronger than the 50%? I wouldn't say so. And some traders will further parse the Fibonacci levels. There are others besides the ones that I have displayed here. I think that it gets a little complicated after a certain point, but the three that I tend to stick with are the 38.2, 50, and 61.8. So, but I don't know that I would put one above another. That answers your question. In fact, quite often, what would make me more interested in one level over another is, did I get a real, did I get like a shooting star up at the top of a resistance level? So if I had a shooting star up here at the 61.8%, I'd be paying very close attention to that. So Dave asks a good question. I'm curious, how likely is it that fibs and other charts are self-fulfilling prophecy of investor sentiment because it is what we are all taught and all using the same charts? Yeah, there's a lot of, I hear a lot of, that's a really good question. I've heard that for years. I've thought it myself. I don't know how likely it is. It comes down to a more practical question, and that is, well, even if it is do I still have the ability to be proficient enough at that kind of analysis to make to make some money? So, theoretically, if everybody was looking at the same charts and doing pretty much the same analysis, it would kind of arbitrage out that opportunity. It would get thinner and thinner and thinner until there's, but I don't think anybody's right enough, nor is everyone uniform enough for that to really happen. A lot of success in trading, I found, is like, there's analysis, which we all spend a lot of time thinking about and talking about, which is what I've talked about today. But then there's, I would say 70% of trading success is like management. Are you managing your risk? Are you managing your positions? Are you, there's always opportunities. So I just don't think there's enough uniformity out there to really present a big problem. And looking for the opportunities is like, 30% of the question. I find management is much more important actually than probably anything else that you can do. So risk management, diversification, how am I managing my positions once I've entered, how consistent am I, things like that. So Susan asks me to draw a fan study over the same points so she can see kind of where those intersections are. So I don't see anything here that kind of jumps out at me in particular, but there are a couple of levels here. I'd be looking at, as the market gets lower and lower, if prices start to coincide with either of these two intersections, I'd get a little interested in that. I've got by the way, if you're interested in that, how these two tools can be combined and use them together on a regular basis, I actually have a video on learningmarkets.com that goes into that in pretty good detail. So you may want to go check that out, Susan, and you get, I've got a lot of better examples in there that goes into a fair amount more detail of using retracements with fan studies. Okay, any other questions? Okay, so Ashley's asking me to apply a time study. So we're going to make this chart really messy here. So I just applied a time study to the same thing, and you know, it's I'm not seeing anything like jumping out at me that I would be too interested in yet. You can probably be looking for the trend to mature a little bit more before I'd be looking to apply a time study to it, and then see where I'm lining up with. But I'd like to see prices move a little bit more, so we know whether it's a trade that we would stay in, or that I would stay in rather, or maybe one that I might want to modify or even exit. So John asks, can additional fan lines be added at 23.6%? Yeah, in fact, you'll notice that I have 23.6, and there are other fan line. I mean, there are other. I'm sorry, John. So John's asking if a 23.6% retracement line could be drawn in the fan study. So I just have the three here: the 61, 50, and 38 in the diagonal fan study. So could you add the 23.6? Yes, you could. I find it just gets, after a point, it just gets kind of crowded. So and that sounds weird that you would make a decision based on just is your chart crowded or not, but it kind of goes back to, you know, there's always opportunities out there, and keeping your analysis really simple rather than the hazard of adding, you know, layer upon layer upon layer is that lots of times it kind of leads to shopping for opportunities. So you almost start shopping for the line that will tell you to do whatever you wanted to do in the first place. So, you know, in the investor education business, in the brokerage business, you get calls all the time from account holders who they want you to tell them what to do that they've already decided they want to do. And that's a real hazard with, you know, making your analysis super complicated and adding a lot of lines, is that you tend to kind of go with whatever line told you what you wanted to hear. So I would say, you know what, yeah, keep it really simple, and that way you can start to get quite systematic and consistent about when and how you're taking opportunities. Otherwise, it's kind of like, you know, well, you know, let me find a line that lines up with what I want to do anyway. Does that make sense? Okay,
hey,
well,
John, could you pull up the Canadian dollar? I'm just curious because I know that volatility has been dropping.
Sure.
CDD would be great.
Mm-hmm. There you go.
Wow.
So this one's the dollar versus the Canadian dollar. So today is a good day for the dollar versus the Canadian dollar, which that's why this has been going up. So today it costs basically $1.05 Canadian to buy a U.S. dollar. So it's been a very positive day for the dollar versus the CAD.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.